So I'm going to give you the quick highlights of Midas Gold. Liz is handing out copies of our presentation. There are fewer slides here than there are in that handout, but they're in the same order, so just flip ahead to catch up. I'm going to make some forward-looking statements. Capital structure-wise, we've got effectively about 410 million shares issued in the money, fully diluted, because the convertible notes are well in the money. There's 0.01% interest rate, 7-year money, largely held by Paulson, but by other investors as well. So if you kind of look at that fully diluted number on the right-hand side, you'd see Paulson's our largest shareholder, Barrick's our second largest shareholder, and then we have a good mix of institutional and other holders as well. So turning to the project itself, we're in central Idaho, so Cal was down at the bottom, Liberty down at the bottom there, and we're in the central part of Idaho. Essentially, there's a gold belt, and you can kind of see it running from Delamar up through our project to Bear Track that runs northeast through Idaho. It's sort of more porphyry-related, intrusion-related. So you've got Thompson Creek, a big moly mine that's currently on standby, but a lot of intrusion-related gold and copper and moly through that whole system. Idaho is a great place to work. It's very pro-mining. It has the second biggest phosphate industry in the United States, long history of silver mining in the north, and other deposits across the state. We did a PFS in 2014, and I'll just use this more as a base to kind of where do we go from here. So it's a 340,000 ounce a year mine for 12 years, producing a byproduct of antimony, just under $1 billion initial capital cost, and all-in sustaining costs about $600 an ounce, and NPV of about just over $800 million after tax. What's changing relative to this? Gold price probably in the feasibility, which is nearing completion, probably be very similar. CapEx, we're definitely seeing some pressures from steel tariffs and U.S. labor costs, putting some pressure on there, and that's definitely a big focus to keep that capital under management. But on the offsetting side, on the right-hand side, operating costs are going down because we've already announced an updated metallurgical right through to pilot scale, where we're seeing higher recovery, coarser grind, various other things that are going to help push that operating cost down. Plus, we also have updated our resource, and we've increased the grade of the first 7 years of production, and we've converted inferred to indicated inside the reserve pit, which will drop your strip ratio. So, there'll basically be a pivot, lower operating costs, higher capital costs. The other factor, and it's in the very small print at the bottom, is these after-tax numbers are based on the former tax rate of 35% in the U.S. The tax rate is now 21%, so that will give you a nice bump in those after-tax numbers as that's taken into account in the feasibility study. So where does this benchmark this project? If we were in production today, we'd be between the third and sixth largest gold mine in the United States. We got the 9th largest resource in the U.S. We got the 7th highest largest reserve, but size isn't everything. You got to have grade as well, and so we're the 4th highest grade open pit mine in the United States. So when you combine that size and grade, what do? You get very low operating costs. So this is the global cost curve for the gold industry, and you can see we're right at the bottom end of that curve in the lowest 10 percentile, and those costs, as I say, are going down because of the metallurgical and resource improvements I've already talked about. So obviously a large scale, very long life, very low cost operation. It's also got very favorable geopolitical aspects. This is basically a chart that looks at how many 300,000 ounce a year mines are there by country, what's the geopolitical risk ranking. You can argue with where they shape out, but individually, but the bottom line is there's only 18 300,000 ounce a year mines in first world countries, and there's only 5 in the United States. So this would be the 6th in the United States and the 19th in the first world, producing more than 300,000 ounces. When you combine that with the prior slide of the low operating costs plus the long life, pretty rare opportunity. So what's the upside opportunity for the project? As I mentioned, the PFS and probably the feasibility will be done at $1,350, we're closer to $1,500. That pushes the NPV up from about $800 million to $1.1 billion at $1,500 gold, without the changes I already mentioned coming in the feasibility, just changing the gold price. Obviously, we don't control that, so we'll see where that shakes out. We do have antimony as a byproduct. It's about 4% of cash flow in the PFS. And it's one of those typical Chinese-controlled strategic minerals. It's on the critical mineral list in the US and Europe. It's about 75% of the global production is in China, but about 90% of the smelting capacity. And a lot of the Russian and Bolivian production is tied up by China as well from a processing perspective, an ownership perspective. And so that puts a twist on this project in the US. It gets a lot of political attention because this is the only viable potential North American significant supply of primary antimony that could meet that critical metal demand. Moving on to permitting, the key to this site is it's a brownfield site. It's a bit of a Goldilocks scenario, not too hot, not too cold. It's a big problem. There's lots of issues from the World War II mining here when this was the biggest antimony and tungsten producer in the United States, produced about 90% of the antimony and 50% of the tungsten for the entire US war effort. There was a smelter there, mill, town site, etc. What did it do? Left a big mess because their environmental standards were pretty much non-existent, plus the war. So tailings were dumped in the valley on the bottom left, unconstrained. They're high in arsenic and antimony. Waste dumps and pits right across the east fork of the south fork of the Salmon River, the last two words being key. So salmon migration was cut off in the 1930s, and salmon had not been able to get upstream. So a key component of our whole design for this project is restoration, and we characterize restoration as getting into a fully sustainable ecosystem as opposed to reclamation, which is just making sure it's not too bad. And so we're going to take that and make it into that. We're going to rebuild the river, make it a fully functional salmon habitat, get salmon upstream for the headwaters for the first time in 80 years. What does that do? It gives you a social license, and probably the best illustration of that is we had the leadership of both parties in both houses of the state legislature sponsor a resolution to the President of the U.S. and all the agencies involved in permitting our project, and 104 out of 105 legislators voted to support the project and see it expedited through the permitting process. So that's pretty unique in these days of partisan politics. We also got a strong relationship with our communities, and so we have a community agreement with 8 different communities in the area. So we're working with them to address their concerns and making sure we don't cause too much disruption. All of that feeds into the permitting process, and essentially we're working our way through that process. I mean, the downside, geopolitical risk in the U.S. is obviously 0 to low, but the flip side of that is the permitting process is painful, expensive, long, etc. But we're well through that. We're about 3/4 of the way through that process now. We filed at the end of 2016. We expect our record of decision in 2020, the end of 2020. The next step is the draft EIS will come out basically at the end of this year. It might come out in the first week of next year, but somewhere around there. The public comment period would happen in Q1. That leads to the final EIS and the draft decision in Q3, and then the final decision in Q4. The feasibility study will come out in Q2. One advantage, there's a silver lining to being delayed on permitting, is it's given us the opportunity to do a lot of value type engineering and sort of really bring a lot of that into the feasibility as opposed to pushing it post-feasibility study. So all that will be incorporated into the feasibility when it comes out in Q2. So that kind of gives you the quick summary. We're going to be at our booth and around today if anybody wants any questions. And thank you very much. Any questions now? I guess we got 1 minute.
That's a full DFS.
Correct, yes. And I characterize probably closer to an execution plan as well, because we've introduced or incorporated all the value engineering aspects are largely complete. Assuming everything goes on the permitting schedule, we would have decision at the end of 2020. Permits would be issued in Q1, maybe early Q2 21, and then you start construction mid-21. It'd be about 2.5 years after that. It's a big project. It's $1 billion project.
Do you think Q4 is realistic in 2020, given what's on?
Yeah, I mean, the good thing is that the expandable part of the process is essentially finished when the draft EIS comes out. And then you get much more into, you just run the sequential steps, and there's more timelines associated with that, but there's no timelines associated with the 2 years, 3 years we've just been through.
Okay,
thanks
great
so
stuff.
much.
Thank you.